Yo everyone, hey, investing in real estate is risky as hell. Like really risky. Like you can lose a lot of money. You can lose all your money. You can lose your ass. I failed you. I forgot my AirPods before the actual live, so I got to throw them in during now. I'm not. Can you hear me? Everything good? Off and hop back on. Investing in real estate is risky, folks. It really is. You could lose a lot of money. You do it wrong, you could lose a lot more money. You leverage the things that you care about. In order to do it, you could lose things that you care about. There's a lot of consequence here, but there's a right way to do it and a wrong way to do it. And I'm not here to discourage you from doing it by any means, but I'm here to discourage you from doing it the wrong way. And that's how we always try to motivate you to invest, and how we try to teach you on this platform, right, on this Invest with Ace page. I'm not trying to sell you a dream. I'm trying to tell you to be a dreamer, but not be a dumbass. To be quite frank with you. Right. So let's pour whiskey. We'll do some prelim stuff, and then we'll get right into it. I should have pre-poured. So surprise, today I'm on time. That's pretty good. I thought I was gonna nail everything, except I didn't have the AirPods in at the start, so you have to hear me transition onto my AirPod audio mid-live, which is gonna suck for the people that are watching this on YouTube. They're gonna be like, oh, what an amateur, which I am an amateur. I'm not an influencer. I'm a real estate investor who just talks to my phone a lot. But I was on time. I did eat lunch and finish lunch like 10 minutes before, which is really uncommon for a Friday. And I took really good notes for the outline today. In fact, I took such good notes that I included a coupon code into the outline notes, and I blurred them out on the story. But what am I drinking? I'm still finishing this bottle of Hipster's Tears that was gifted to me. They're delicious, by the way. You should try them sometime. Cheers, everybody. So I promised you a coupon code for the people that are here early. This coupon code is not yet active. It will be active once this live is over. I will go on the Sellfy store. I'll activate it, and you'll be able to go ahead and hop on the store and purchase a free copy of the deal calculator or the due diligence guide with the contract pack. In the future, some more products too, right? So what is investing in real estate? It is risky AF. Can you read in reverse? If you guys can read in reverse, the coupon code is all caps, risky AF. Write it down. When the announcement comes out, it won't come with a coupon code afterwards. So if you are here, one of the loyal people that sneaks off from their job on a Friday when their boss isn't looking and just has their kid jiggle the keyboard so it looks like they're not on away mode so they can watch this live about investing in real estate, thank you. You might get something for free afterwards. Maybe I'll give away 20 copies. Does that sound good? 20 freebies, and then I'll do another 25 freebie giveaway when we hit 160 followers pretty soon here. Thank you guys for the support and showing up to these lives. So I don't know why I threw that back there. I'm getting all swaggy on you, and I haven't even had a drink yet. I need this. Let's talk about risk management in real estate, right? Seriously, and let's make it a little bit more strategic. We're gonna break it down in order of a couple different things. Here's the structure of today's live, and I'm gonna keep it shorter, I promise this time, and then spend more time on Q&A, which is what the people really want. You don't really wanna hear me talk, you just tolerate me for 30 minutes, sometimes 45, so you could ask me that one burning question you had that's keeping you from that $10 million profit margin that you're gonna make. I'm not telling you the coupon code again, you had one chance. Yeah, one chance. Just kidding. It's risky AF. RISKY-AF, all caps. Write it down. You can't use it yet. Don't leave. I don't want to see the numbers dropping. It's not active until after this live. Right around 1 o'clock, I'll go on and I'll turn it on and I'll make a story announcement. So look out for the story afterwards. That means it's active. The structure of today's live is going to be about risk management, and it's going to be broken down in this format. What's going on right now? What's making people engage in such risky investment behavior and just consumer behavior, right? What's going on with the world of retail spenders and investors? And then I'll break down some of these risky behaviors in categories. It's going to be, I'm not going to tell you what the three of them are right now, but I'll break down these three major risky behaviors actually, and I'll even throw in a fourth one, like kind of a bonus honorable mention. We'll talk about why they're risky, and then how to do them right, or how to manage your risk when you're engaging in these kind of behaviors to try to come up on opportunities, to be able to capitalize on investment opportunities. Then I'll finish up with three big risks that I took over the past multiple years that are different, right? They're all in different phases of my life. They're all different types of risks. They're all financial risks and real estate related risks, right? So don't worry, it's nothing from college or nothing too crazy. And I'll tell you how the risk was managed and why they ended up working out, and whether I could have maybe thought about them a little bit more intelligently, but also why they weren't overly risky or too impulsive, right? So I'm gonna be super transparent with you guys. I love being transparent with you guys. Ask me any fucking question you want. I've got the answer for it. So what the hell's going on right now with the economy, with the consumer? Guys, it's strong. I mean, there's a lot of money out there. The economy is doing really well, right? And usually, incidentally, when the economy is doing really, really well, like when it's doing as good as possible, is like right before it like stops doing really well, right? If you've ever like taken a look at like the stock market graph over the past 50 years or just history in general, that's kind of how it works out. The economy's really strong right now. It's at a relative peak. It's higher than it's ever been before. Could it continue to go higher than it's ever been before? Absolutely. But it's been at a relative peak for a while, and it keeps breaking new records over and over and over. And there's a lot of money out there. There's a lot of money out there. So think about it. What happens when there's a lot of money out there? You know the answer to that. When people have full pockets, they get spendy, right? There's the stock market's at an all-time high. Crypto valuations are extremely high. A lot of people have been made wealthier through their positions in these types of assets. Technology companies surging, right? There's kind of like a new industrial revolution in the world of like the cloud and software and AI, just big tech, right? And their employees walking in with tons of stock options and really high salaries. One of my buddies is a recruiter for a tech staffing firm in Southern California. And he said he tried to recruit a software engineer to Lyft, pay package $550,000. $550,000. The candidate declined because he took the offer back to Facebook where he originally worked, and Facebook gave him a don't worry about it offer, a counter offer, significantly higher, right? That 550 was supposedly between like salary, stock option, and maybe benefits and perks and fringe benefits and things like that, right? But 550 he turned down because he was getting a better offer at Facebook. They basically told him, just don't even fucking think about getting a different job. Shut up, do your job. Maybe they said, here's $700,000-$800,000. Crazy, right? People have really full pockets. When they have a lot of money, they spend their money. There's stimulus money out there buying consumer goods, driving the values of those up, and investors are investing in the companies behind them, driving the values of those up, right? So everyone's got a brokerage account or a 401k or even cash that they've cashed in. Maybe they've sold a property. Their house in California is worth so much more. Everyone's net worth is higher than it's ever been. My net worth is higher. My net worth is higher than it's ever been too. Fortunately, like 40% of my net worth is in a cash position, which I know sounds insane to you guys, but it is. I keep a heavy cash position, but a lot of people have very, very high net worths, and that leads to different behaviors. When you got a bunch of money, look, I make a bunch more money than I used to, right? A lot more. I probably make about 20 times more money than I did 4 years ago. And now, as a result, I'm such a fucking cheap ass. I still cut my own hair, right? But if I want to go out on a weeknight for a couple beers, I don't stop at the first round. And I don't only do it once a week. I don't limit myself. When we have more money, we're willing to do more. And some people are willing to do maybe more than they can handle. The people that were always willing to do more than they can handle are willing to do a lot more than they can handle when you put money in their hands, right? It's like, how they say when someone gets drunk, they're much more so themselves. When someone gets money, they're much more so themselves as well. So consumers, when the economy's good, get brave. They get real brave, and they go buy that expensive house, and they go buy that expensive car, and they go buy those speculative stocks, and they go buy that investment property. Then they go take out home equity on their house that they bought a year ago that's appreciated so much, and they use it to go buy more speculative investments or investments that they're just not prepared to own. And they don't think they need to keep extra cash. They don't think they need to keep extra savings from their monthly income because their income just keeps growing and growing and growing, and it's so strong. And that's kind of the behavior that pushes the economy to a really stretched position. When something stretches, it naturally does contract back to a baseline, and usually it overcorrects, right? If you think about like a rubber band, right? If a rubber band at rest is this big, and then when you stretch it to maximum ability, it's this big, right? I'm just trying to stay within the scope of the screen. It's this big, and then when you snap it, it doesn't go back to its resting position. Its ends touch, right? It goes beyond its resting position, it overcorrects. And that's exactly what consumer behavior does, because the economy is really a function of the behavior of the masses, right? Corporations and governments just react to the consumer. That's really all that's happening here. And the consumer overreacts to the environment or each other's behavior. It's kind of this excessive herd mentality where they're trying to stay ahead of the curve. So consumer behavior, really strong right now. Investor behavior, willing to pay for things that they wouldn't before, willing to take risks that they weren't before because they feel invincible because they have money. Think about that. right? What the implications of that are, and what end of that you want to be on. What does this mean for assets? Look, there's always someone out there that's willing to make less money than you in a time like this, which means when you go out to, whatever market in the Midwest, Indianapolis, you want to bid on a rental property. There's going to be someone out there that doesn't need to make as much cash flow as you to jump on that investment because they feel so confident it's going to continue going up in value. You, the reasonable investor, says, I need cash flow. I don't want just value. I want an 8 cap. Someone else out there goes, I don't care if it's a 5 cap. Look how much value it's gone up in the past 2 years. They're myopic. They look at a specific period of time. Usually the consumer looks at when it comes to investing. The consumer investor, the retail investor, they'll take like the past 1 or 2 or 3 years worth of trends and they'll project them forward. They'll extrapolate them forward rather than looking at like just the broader economics and then also what's happening in this instantaneous moment that may affect value tomorrow and then 2 years from now and 5 years from now, right? So they look at the past 2-3 years. Well, guess what? The past 2-3 years have been fucking great. The past 10 years have been great. Why? Because we're coming out of the worst crash the country's seen since the Great Depression, right? So naturally, everything's just gone up at a crazy rate. Most of it recorrection to normal value. And then, like we said, the rubber band overcorrects every time, right? When it hits the bottom that hard, then it bounces past the median and it hits the top really hard again. It's like a ping pong ball bouncing between two walls. It never just floats in the middle like it's supposed to, right? So asset valuations, they feel like they're past the middle right now, and it's because people are willing to spend money because they're willing to make bets on things without fundamental valuation. Real estate's expensive. Stocks are really, I'm not even buying stocks right now, and I want to buy like $5,000, $6,000, $7,000 minimum worth of stocks a month just with like my personal spare income from the business. Not even within the business, and I'm not finding anything I want to spend on. I'm just stacking that $5, $6, $7 away every month, right? And the business wants to buy a lot of everything, and we're not buying stocks. And even real estate has become harder to purchase at reasonable valuations, actually. So we're purchasing less real estate, which is why our opportunity fund is growing bigger and bigger and bigger. If we found a bunch of good deals, guess what, guys? We wouldn't have a bunch of cash sitting in a bank account. We wouldn't need to, because when you find really good deals, they're worth emptying your pocket over. But when you don't, do you get the FOMO? Or do you hold strong, stay the course, stick to your criteria, and adjust accordingly? That's what it means for assets. Risky behaviors. There's 3 big risky behaviors that I'm seeing right now. One of them is buying speculative assets, right? What's a speculative asset? I don't know. An asset that you are buying for the purpose of capital gain in value without actually doing anything to it. You're speculating that the market is going to continue to drive the value of something up without you doing anything to actually drive the value up, or without you buying it at a mispriced value, right? So like, let's say you look at, Bitcoin or Tesla shares or something else that's like highly volatile that has been growing rapidly. You take a look at that asset and you say, well, I'm not buying it for less than what it's, worth to the rest of the market today. I'm not buying it for less than what it's generally worth overall to the market over the past 5 years, 10 years, whatever it might be. What fundamentals do I have in my head that tell me that this is going to be able to go up continuously over time? It's undervalued relative to the future value of it. That's speculation, right? Regardless of whether you're right or not, it's speculation. Now, if you are using the wrong fundamentals to bet and you are misunderstanding the valuation of an asset, which is very, very hard to get correctly anyways, right? Because the economy is very unpredictable, especially in new volatile assets, stuff like NFTs, right? It's very, very hard to say what these things are truly worth relative to tomorrow's value and yesterday's value because they're so new and so volatile. That's speculation. You're betting. That's all it is. You're just betting, right? It's not like me buying I mentioned today in the story, I bought a house for 30 grand that I know I could sell for 75 today. The cash flows, if I can't sell for 75 today, and over the course of the past decade, this house in the condition it's in was never worth less than 45, and that was at the bottom of the market. In the past 3 years, it was never worth less than 60, right? So there's some sense of fundamental valuation attached to that makes me go, I can speculate this market's going to continue to grow, but I know if that's wrong, I've got some history of value and an understanding of tangible value that has a lot of buffer in it, right? That is safe speculation, where you go, it's okay if my bet was wrong, the investment still wins. Does your speculative investment win if your bet on growth was wrong? Is a good question to ask yourself. And the answer is, if the answer is no, then here's what you got to do it right. Take your bets with a specific portion of your portfolio. It's up to you to decide what that portion is. I would say a relatively small portion. Now, the size of that portion is relative to how much extra cash you got laying around too, right? If you've got $5 million in the bank and you've got, I don't know, a $5 million investment, $10 million investment portfolio, maybe you're not scared of 5 of it being in fucking Bitcoin or Tesla or Apple stock or whatever else feels expensive right now that's going to keep going up and up. California real estate, right? Austin, Texas real estate, whatever it might be. Single family homes in these type of markets. You're in a decent position that if you lose there, okay, you got more liquidity. But if you don't have that much liquidity to absorb a loss, then maybe you might say, hey, I want to right size this as a proportion of my portfolio. I want to apportion my portfolio across different kinds of assets and make the speculative assets a relatively small chunk of them. That's a good practice, guys. The next one is money you're willing to lose. Bet on speculative assets with money that you're okay with losing. That's it. I mean, I threw 15 grand at Alibaba a couple weeks ago when it was undervalued. Could it go lower? Yeah, for sure. Did it feel cheap compared to the sector? Very much so. And compared to its free cash flow? Very much so. Am I telling you guys to buy it? Absolutely not. If it dips, am I going to keep buying? No. Why not? Because I'm right sizing it to my portfolio. I don't want that much exposure to that kind of stock in my portfolio. I just want a very small amount of exposure. And it's money I'm willing to lose. And I'm never going to sell it because it's a giant company that's not going to go insolvent. It's highly unlikely. And if it does, that's fine. 15 grand, guess what? I won't notice a thing. I'm good. You want to be good too. The next bit is fundamental valuation. Do you have a sense of what this thing is truly worth? If you take away the emotion of the rest of the market, do you have a sense of what this thing is truly worth to somebody? And then yield-driven assets, guys. Buy your speculative stuff. If you're going to buy it, keep it small, have extra cash, whatever it might be. And then buy stuff that cash flows, because that way, if its value fluctuates, you have other means of generating a profit from these investments that'll float you while the value is volatile until you can ride out that volatility over time. Because yes, that California real estate, it is probably going to be worth more 20 years from now than it is today. But it might be worth less in 2 or 3 years. But if it cash flowed well enough, you could ride that wave and you wouldn't feel so bad about it. It wouldn't be the most optimal investment if it lost a ton of value compared to the rest of the market, but you wouldn't die. It wouldn't bankrupt you. You'd be good. Why? Because it's putting money in your pocket. It's sustaining itself, right? So you can absorb, the property can absorb its own risk by means of its own profitability. So yield-driven assets in this kind of market. I'm a conservative investor, by the way. If you guys didn't know that, let me go ahead and preface the rest of this live with I'm a conservative investor. These are strategies for conservative investors that don't like to lose money. If that's you, go for it. By the way, I don't not make money as an investor because I'm conservative. That's another myth, is conservatism means you're leaving a lot of money on the table. Not necessarily. You could be leaving some money on the table, but you could be making a lot back elsewhere because you're doing something that is highly predictable to be profitable, maybe at a very high rate too. You just don't do the stuff that's not highly predictable very often. Because we're doing all right with these hella boring investments. I invest in the most boring shit. I invest in stuff that like my dad would have found boring 50 years ago. That's how boring my investments are. And god damn, do they just put money in your pocket. Number 2, risky behavior number 2, over leveraging. I am going to, without identifying anybody, tell you the story of an investor client of mine that came in a couple weeks ago. Big supporter on social media, great guy. And oftentimes we find that people who really love our page and love our content, they're so bought into our brand, maybe because of the honesty and the transparency and kind of the message or the education or whatever it is, that they feel so convinced they have to invest with us right now. Maybe they're not prepared to invest with us though, but they feel like they have to be a customer. They have to be a customer, and that's not at all what we mean to push on our page. We don't want more investors who are not very, very easily and comfortably qualified to be able to make these investments and absorb whatever risk that comes with them, even though we try to minimize it for them, right? And by no means do we want a new customer bad enough, regardless of how good they are, to put them in a position where they're not prepared to absorb the risk that that investment adds to their portfolio or their overall financial management strategy. But this guy, great dude, came to us, said, hey, my house is worth $930, right? It just appraised at $930. I owe $660 on it. I want to cash out, refi, and invest with you. It's in the Bay Area. I want to cash out, refi, and invest with you. I'm like, that already kind of concerns me. So my first question was, how much liquidity do you have? Liquidity meaning money in brokerage accounts, not 401k or IRA though. and cash. And he said $28,000. I said, absolutely not. You are not going to invest with us. You're not going to take equity out of your home, the last 120 or 130 you have, and then use it to buy investment property with only 28 in the bank. Because in my head, I knew, hey, with all that debt that he's got and that limited liquidity position, most banks are not going to approve him for a loan for another investment property. So he's going to have to buy cash. If he buys cash with 120 in equity and he only has 30 left in the bank, then he's really exposed to something going wrong. Think about it. His mortgage on his home jumps to $800,000. That's a high level of debt service on a 30-year loan right now. What is that, $5,000-$6,000 a month? $5,000-$6,000 a month. I looked at his Instagram page. He's married. He has 2 young kids. He has an expensive house. I don't know what he does for work. I don't know if he makes a very, very high income. I didn't ask that question. But the liquidity tells me the income wasn't disproportionately high. And I say, in my head, hey, this guy could lose very easily. 28K is not a big cash reserve. It probably gets him through about 3 months cost of living reserve. And then you've got the investment property where things could go wrong, especially in the first year of owning an investment property, and it might not be profitable. And that particular property wouldn't have made him that much money, by the way. You know, a 10 cap, a 9 cap, an 8 cap on 120K, that's about $10,000 a year, about $800 a month. He's got to pay back that extra debt on his mortgage, that 120 he pulled out, that's probably like $600 a month. So he's going to net about $200 a month in cash flow, hence the inspiration for one of the posts I made earlier this week. All that risk to make $200 more a month is not worth it. Be careful not to leverage your home, guys, if you don't have the right strategies in place. And really, there's no real strategy for, should I take equity out of my house? And if so, how should I do it? What should I invest in? Taking it out of your house has nothing to do with the overall debt management strategy. Debt management is debt management, right? And here's how you do it right. You manage debt 3 ways: with your income, with your liquidity, and with the debt coverage of the asset that you're reinvesting in. Income, obvious, right? Are you able to cover all of your debt obligations and all your cost of livings and make still significantly more than that monthly cost? Do you make a lot more than your total obligations? Or do you only make 20% more than your total obligations, or 30% more, or 40% more? Obligations including taxes. This is not debt to income ratio, right? I'm talking global cash flow. Includes your taxes, includes feeding your kids, includes paying your mortgage, includes driving your car to work, includes your emergency fund, all those includes taking your dog to the vet. I've been taking my dog to the vet, guys. It's going to cost me about $12,000 to remove a big tumor and then give him radiation therapy afterwards and all this stuff. Surprise expenses, can you cover them with your income? And then number 2, your total obligations, can you cover them with your liquidity, right? How much cash do you have? In his case, 28 grand, it didn't get it done. He covered maybe 3 months of his total expenses with that. That's it, maybe 3 months. If you want to be conservative, 1 year of liquidity, a full year of all your obligations, that's it. I mean, especially if you're going to invest it in an asset that is not necessarily going to make you a ton of money, but just a little bit of money. The upside's low. The upside and the added risk are like even. There's not really much to gain from it, right? Especially when you're buying that asset at top of market value. How do you know it's going to continue to go? Well, it might lose value, and you'll be having that cash flow, great, and you'll be paying off the debt with the cash flow to some degree. That's really cool and all. But if your equity in your house and your equity in your investment property then dip 20%, you're underwater, you have negative equity, and the cash flow is really making up your negative equity. It's just basically pulling you up out from underwater so you can breathe again. Is it really worth taking on that extra risk just so your cash flow could be used to pull you out of the hole that it dug you into potentially if the market shifts? You got to ask yourself that. My answer is no to that, right? So careful with the home equity. Income, liquidity, the third bit, debt coverage, right? If you're gonna add debt, the thing that you add it to purchase, the rental property that you use when you add that debt, the rental property that you use that debt to purchase. I'm brainless sometimes, guys, it's Friday. Does it cover its own debt obligations? If you've got a $100,000 payment on 125K or a mortgage on a 125K duplex, and your payment is $600 a month, $550 a month, whatever it might be, right? And your expenses are another $600, $700 a month, including taxes, insurance, property management, a reserve for future vacancy, a reserve for future maintenance, landscaping, utilities, future capital expenditure that may occur. All those expenses plus your mortgage on that property, how much lower than the net cash flow are they, right? It's called debt coverage ratio. Your net income from the property after expenses, is it significantly greater than the mortgage payment on that property? And not just like $100 above, because that's just enough to like buffer out surprises. If your debt coverage on the asset is strong, then maybe that debt could be justified. The higher the market, the higher the debt coverage ratio I look for, period. Unless I've got a lot of liquidity or a lot of personal income that warrants me spending the money because I just can't leave that much in the bank, right? Debt coverage is the third bit of debt management. So the three are income, right? Being able to pay for it yourself. Number two is liquidity. Do you have reserves to cover it if shit hits the fan? Number three is debt coverage of the asset. Does the asset sustain itself with a healthy margin of safety? I'll take questions in a little bit. And look, the third big risky behavior I'm seeing is in strategy and execution. People are using their last dollars, the only money they got, because they think money's so abundant it's always going to keep coming back, to do things that they have never done before, that they have no experience with, that they have poorly strategized around, that are not likely to work very well, or they'll have an uphill battle figuring it out. Don't use high risk money, the last money you have, to do something that you're not that confident you can convert on. You want to make sure you can execute well with that risk that you're taking, right? If you're not very confident in your ability to execute, then the chances of winning, of getting the reward from that risk, are lower and lower and lower and lower. Do things that you're good at. That's the biggest thing. Do things that you understand, like taking out home equity to get the maximum debt you can on an Airbnb property when the vacation market's as hot as possible, and you've never operated Airbnb, by the way, and the cash flow on it isn't going to be that strong necessarily either. If you crunch the numbers, it's not perfect. And the property is being purchased for more than what a regular rental property investor would pay for it. Damn, you better be a really fucking good Airbnb operator. You better be a really good Airbnb operator, because that's not a home run. And that's kind of number 4, the honorable mention, right? Home runs make every risk more worth taking, right? Look, if you got a property for $100,000 and you know you could turn around and sell it the next day for $2 if it didn't work out, crazy deal, lucky deal, then I'd probably take a larger risk than I'd be normally comfortable with to purchase that property. And I'll give you an example of that later. And don't try to convince yourself that every opportunity is this golden opportunity. You better have some damn good justification. I don't mean based on tomorrow's value. I mean based on today's. If someone brings you a house today, we did this week. I just closed on a property today, $30,000, cheap little house in good condition, inside and out and mechanically. Long-term tenants, sellers owned it forever. We bought a pack of 10 houses from him. He hit us with a good deal, but the house is worth 75. All right, if I had 50 grand in the bank, 40 grand in the bank, right? That's it. And I was new, I'd never invested before, but I knew for certain that I could turn around and sell this house for 75 or 70 or 65 or 60 worst case. And I'm getting it for 30 as it is. I'm gonna take a bigger risk than I normally be willing to take to purchase that house. Wouldn't you agree? So when it's a home run, adjust your risk tolerance, tolerate a little bit more, but make sure it's really a home run. Those are the 3 big risky behaviors: buying speculative assets, over leveraging, and then doing new things where you're not confident you can execute as a venture with your last bit of money, taking risks on stuff that you're not experienced in necessarily, with a lot in and not a lot of upside especially. I'll give you 3 risks that I took from different phases of my life that really paid off. And when looking back, they weren't that risky. And I'll tell you why. The first one was buying my house. I bought my house when I was 23 years old in 2013. It's in Sacramento. It's in I'd say a B minus neighborhood, right? It's not in a fancy neighborhood. I still live in it. I owe 145 on it, something like that. It's worth probably like 525 or something like that. I bought it for 235 in 2013. In February of 2013 is when I closed. Got into escrow in early January. Get this, I put 20% down, so that diminished my risk, but that was all the money I had. That's all of my savings. I had 52 or 53 grand saved up. So purchase plus closing costs ate up every bit of my savings. but I got to buy something, get this, $1,100 a month payment, cheaper than renting an equivalent. Rent back then for the same house would have been like $1,600. So cheaper than renting, and I was gonna rent anyways. I didn't have a job at closing. Now I had a job through escrow, but it was a contract job, and I knew it was ending right after closing. And I knew I was gonna get another one. I had opportunities lined up, but I hadn't locked them in yet. But I took this house without a job, basically. I moved in 3 of my buddies. They paid the whole mortgage and some, and then unemployment that I got afterwards covered my gas, my food, my gym membership, which was like $300-400 more a month at the time. I was living really cheap, right? Maybe $500 a month. And then I saved like $1,500 a month on unemployment for the, I don't know, 30 days that I was on it, 3 weeks that I was on it before I found another job. It was a narrow margin when it came to using up all my cash reserves, but it was a very, very good buy that I had the expenses covered reliably for, that I put a pretty big down payment on, so I had a deep equity position. And by the way, if I had to get help from anyone, I could have gotten help for $1,100 a month pretty easily from mom and dad for like 2 or 3 months. Not that they could really afford it, they were pretty broke too, but they would have made sure I didn't get foreclosed on my house until I had a job. I could have worked at any place. I didn't have to go back to biotech. I could have worked at any job and afforded to pay that mortgage with those roommates covering it, or afforded to pay my gas and food and gym membership bill, right? So really, really low risk of failure if you think about it, but just emptied my pockets, but got a house for $235 in California that was very, very undervalued, right? That's a risk for the newbies that might be worth taking, but the problem is the housing market isn't that cheap right now, so you really have to make sure you get your bases covered, and you don't want to take as big a risk as I did on your first house in a toppy market, because if it were $600, guess what? I wouldn't have been able to buy that house, and I definitely wouldn't have emptied every dollar out of my pocket to buy it either. Another risk I took a little bit later, quitting my job for this business. So someone hit me up after I made some posts about risk management this week saying, dude, don't be a dream killer. These are the same exact risks that you took. You're telling people not to take them, but this is how you became successful. And I'm like, bullshit, that's not true at all. That's complete bullshit. I was making $10K a month at my job that I quit before I started this business full time. Now, I was already doing the business, right? The month that I quit my job that I made $10K at, Mike and I made $40,000 working for 2 hours a day that same month in this business. And then the month before we made $25,000, the month before we made $15,000, the month before we made $15,000. We were consistent and growing, and we had more coming in the pipeline, and we had more contracts in place for future months too. So yes, I quit my 6-figure job to start this business. However, we did not quit it until we had significant cash flow from the business coming in. We had more than replaced our income. We had no overhead in the business, no employees, just $500 a month of marketing is all it cost to run this thing. I had still been house hacking, my whole mortgage was covered, and then we each had an extra $50,000 in the bank as reserves with very low overhead. It was an easy risk to take. In fact, I talked to my boss when I was quitting. The owner of the company actually was a little software startup. It was like 130, 140 employees at the time. And he said, you know what, man, I'm surprised you didn't quit months ago. If I were you, it would have been 6 months ago, I would have quit. So that felt like a risk to me at the time. And to you guys watching, it seems really impulsive. I quit it on a Monday morning randomly. I left a 6-figure job on the table, right? But we were making $20,000 a month working 2 hours a day. I saw it as a bigger risk to stay at the job, because what if we were working 8 hours a day at this? That's how we saw it. Oh my God, if we're making this much money, working 10 hours a week, 12 hours, 16 hours a week, because you include the weekends, right? 16 hours a week each. How much could we do if we worked 50 hours a week each? How much opportunity is being left on the table here that's right in front of us? It's in our pipeline, right? And it ended up materializing and being true, because by December that year, I remember we had like a $75,000 month, 2 months after I quit my job, right? A month before, we bought a flip that we ended up profiting 6 months down the road. We ended up profiting $80,000 on it. A month before that, we had a slower one. We made only 15. So, we quit, then we made 15, then we made 90 basically, and then we made 75 after, and then in January we made another 40, and on and on and on and on. Within less than a year, we were making 100 a month in this business. So it wasn't that big of a risk. Risk number 3 is a little more recent. It's an investment property risk. All right, so this is something for everybody. I'm trying to give you a risk that I took that applies to everyone's different ambition or aspiration that's watching this video or following this page. We locked in a 16 unit in Louisville, Kentucky last August for basically negotiated over the course of the escrow for 700 grand. Market value was about 1.1. We're in the middle of a wholesale deal. We're going to pocket quite a bit of cash from this wholesale deal. Escrow fell out because underwriting was really hard during COVID. Properties and borrowers were getting stressed with all kinds of extra reserve expenses, and deals were falling left and right. Well, this deal fell, and the seller basically had her attorney reach out after like 3 months in escrow saying, shit or get off the pot, right? Attorney said, you guys got to close. You got 2 weeks to close or we're canceling the escrow. And Mike and I didn't have a loan lined up. We had this $700,000 purchase that we knew was worth way more. What do? We bought it cash. And it was a lot of money. It was a lot of money. It was kind of scary, I'm not gonna lie. And to be quite transparent with you guys, I think we had like 1.3 in the bank at the time, 1.3, 1.35, something like that. And we had other rental properties that were recently purchased cash as well, right? The months trailing. So we had used like 300 grand cash recently. And I know we had other deals closing, and we knew that the business was going to consistently generate revenue, and it was growing at a really rapid rate. Everything was going well. And 600 grand would have run the business, right? For sure. Because it's not like our business has ever had a cash flow negative month, never had a cash flow negative month or quarter since its inception. But nonetheless, $700,000 cash is pretty scary, but we had backup plans. We had a refi plan. We had other lenders that were willing to finance us. They just needed to start the process, and we didn't have time for that. We had the ability to sell off some of the portfolio, which we ended up selling off the 4 unit and did a cool tax trick to transfer all the equity into the first 12 units. We had other money in the bank. We had other revenue coming in. We had cash flow from the property coming in. We had a lot of different options. And by the way, the property was worth way, way more than what we paid for it, right? So we could have sold it for a whole lot more. Long and short, that 12 units that we kept, you guys know the story if you've been here for a while. The 12 units that we kept, we essentially got them for $475. Sold off the fourplex for $225. That was the $700. We broke even on purpose on the fourplex. We overpaid for it and then just sold it at its market value so we can get all our cash back without getting taxed on it. Transferred the equity into the other 12. So we were in the 12 for $475. It appraised for $880. A couple months later, all we did was replace a water heater on it. Risk worth taking with a lot of options to get out and a lot of margin of safety in a lot of different directions. But an uncomfortable risk nonetheless, but one of our best deals to date. I mean, we walked into $405,000 of instant equity. Instant equity. Imagine if we 1031 that thing. We're gonna come out of that thing with $450,000 of equity that'll roll into another property that's gonna be a $2 million purchase essentially. That'll probably be worth 2.5 or 3 because we're gonna buy discounted deals with it, right? So an investment risk worth taking, too good of a deal to leave on the table. It's that home run concept that we talked about, right? So those were my 3 example, kind of big, crazy risks. Maybe you guys didn't think they're that crazy. They all felt crazy to me at the time. Is buying the house with every last dollar I had when I was 23, quitting my job on a Monday morning, my 6-figure job on a Monday morning to start this business, only 5 months after starting the business as a side hustle, and this $700,000 cash purchase that we did not want to spend $700,000 cash on. That's the biggest wire transfer I've ever made in my life. That's it. This is the part where I breathe and take a drink. Coupon codes at 1, remember, after this is all over. So stick around, or at least watch the stories. And hit me with some questions, y'all. Let me know what you got. Ask me questions about stupid, risky shit that you want to do so I can tell you whether it's stupid or not. Never quit on a Monday. No, I quit on a Monday at 9 a.m., man. I could not tolerate it any further. My boss used to be the owner of the company. He was a total entrepreneur, so he very much loved working with people like myself and then the previous sales guys. He just kind of let us have our space if we were closers, and we killed it and we did well, right? But the company had to grow so that it could be marketable to sell, so we brought on a sales manager. Sales manager micromanaged me over kind of small stuff, and I didn't really have the energy for it because I was killing it. I didn't need to be told what to do. I didn't want to be told what to do by somebody who didn't know what they were doing, to be quite frank with you. Owner knew the guy didn't know what he was doing, but he needed somebody to take over the position so he can grow and sell this shit. So yeah, I think he took me off the inbound leads board because I didn't do one little administrative task on a contract that I had received and closed out. So I was like, all right, dude, this is fucking stupid. I'm out of here. So I reached into my drawer and I grabbed my tub of protein. I had a little Akita figurine because I used to have an Akita, big old American Akita, and so I put that in my pocket. I think I got my mouse, which was I just replaced it here. It was my little MX Master that I loved. What else did I have? I think that was it. And then just walked into his office, the owner's office, and I said, hey, I'm out of here. I didn't even tell the manager. I just walked into the owner's office and said, I gotta leave. And he said, I'm glad you did. And I'm sure he didn't give a shit, because turns out on the news, 2 months later, they ended up selling it to Fidelity, the whole company, for $100 million. Guy was 33 years old. Pretty good haul, if you ask me. He did not give a shit that I was gone on that Monday. He was happy for me. What else? You got a deal for 3.8, 49 homes in the Midwest. You don't have the 25% down. What would you do to try and get the deal? Raise, if it's a good deal. But if it's like barely discounted and you don't have experience with this kind of deal, I don't know if you'll have much luck convincing investors. I think having the structure in place before the deal is brought to you is really important. It's very, very hard to build the business to buy the deal, or put together the model to buy the deal once the deal already exists and is in front of you and is being marketed, especially, right? So it's up to you to assess, is this too good to pass up on? Is it way too good to pass up on? Because if it's not, your investors probably aren't going to take the leap of faith with you. But I would raise if I were you. Just go get some money. I mean, 3.8%, 25% down, it's $1 million. $1 million is not a crazy amount to raise, but if you've never done it before and you don't have an investor network, it might be difficult to find $1 million. It's all relative based on, I guess, your position in your business. Do I recommend buying around Los Angeles? No. I mean, why would you? The laws suck. The moratorium's still going. The properties aren't discounted, really. The market's really hot. Like, yeah, it could grow in the future, but that's a volatile market that has high highs and low lows when it crashes. And unless you're buying something at a substantial discount from market value, I'd say there's better overall markets to buy at market price than LA, especially for residential rental property, because the laws are just horrible here, man. For landlords, right? I'm not trying to make this political. It's pretty objective there. Best negotiation tactics. I got one for you. Justification. Have a reasonable explanation for everything that you're requesting and asking for in a negotiation. It's that easy. You're not trying to fucking haggle with the person, right? You're just trying to put together a reasoning for your pricing, your terms, your valuation, whatever it might be. The next bit is, what additional value do you provide to them if they select you as a buyer? We're worth something to our sellers, right? Much more than the next offer that might price $1,000, $5,000, $10,000 higher than us necessarily, right? And that's because we are guaranteed for the seller. We're guaranteed, our process is smooth, we're not gonna haggle over little things. They're probably gonna end up at the closing table with more money from us than the person who bid $10,000 more in the first place. So what's your value to the seller or the other person you're negotiating with? Do you have some value outside of just the linear portion of the deal that is maybe a little less tangible that you can demonstrate that makes them want to work with you, even if it comes at some level of exchange or sacrifice? That's a good negotiation tactic. I like to keep it honest when it comes to negotiating. I don't like to use the dark arts, but if you gotta get dirty, get dirty. I'm not gonna tell you guys how to get dirty. You can figure that shit out yourself. I got some dirty negotiation, below the belt negotiation tactics for sure. I don't use them very often. You don't need to if you set it up correctly. Am I posting this video? Yes. So last week, what happened is Instagram glitched out on me while I was trying to post it directly from here. And because it was longer than an hour, I couldn't even post it through my desktop after, so I just put it on YouTube. So last week's video is on YouTube. It was a good one. I think this week's was better. It was better planned. It was well structured. It was kind of hot topic. But yeah, this one is going to be posted on Instagram, IGTV, and then on YouTube as well. Go give me a view on both. Help my algorithm out. Run it on YouTube. You can watch it on your TV that way too. Get me to the monetization phase on YouTube. Grow that page a little bit. What do you got? Man, I'm losing my breath on this shit. No work history, but want to start investing in rentals. Any advice? You know, man, go make some money. Like I said this on a recent live, and someone reposted the snippet. I loved it because it was not because it was a pat on the shoulder, right? I mean, I get pats on the shoulder from you guys all the time, and I appreciate those too. I loved it because it was something that I see as an extremely valuable piece of information that's often overlooked by the overall audience, right? And it was, don't invest until you have a money problem. Give yourself a money problem first. Like, if you can put so much effort into learning one thing to make yourself wealthier, and your options are to grow your income or to learn to invest, guess what? If you don't have a lot of cash to invest, all that effort to learn to invest just so you could put $100, $500, $1,000 in, a little bit more, try to do it with no money and no expertise to raise money, what's the point? Go get some income. Focus on generating enough cash And then investments are just a place to put the cash once you got it. That's my attitude about the whole topic. And that was my business very much as well, right? We bought rental properties early on in this business, and then we sold them all because we realized that it was pointless. We needed more revenue and we needed to grow this business. And then we didn't start buying rentals again until last July. And guess what? By then, we had developed the business well enough. We were making plenty of cash that we've bought over 60 units. And what? Right now we have 17 units with a loan on them. So we've got like near 50 units purchased free and clear, plus 17 more with financing, with under-leveraged financing, 50% LTV in just the past year. Strongly recommend investing in your money engine so that your money engine makes investing in assets easy for you. But what the fuck do I know? You're on the investor list. When can you expect emails on deals to purchase? You got to answer the questionnaire that comes in immediately first. There's some qualification questions. If you do qualify, you'll be transferred over to the list that receives distribution emails. That list is capped at 1,000. We get 20 to 30 new investors that claim to have 100K or more to invest every day. So we do have to manage that list and make sure the most active and engaged people are the ones that remain on that list. If you're not communicating with us, you're probably not going to communicate enough to buy a property. So why show them to you in the first place is the way we see it. Because there are so many people right now that we have to serve, and want to make sure we focus our attention on the people that really want it. Right? I hope you understand. So yeah, take a look at that questionnaire you got in your inbox, and you will have an opportunity to apply to be on the list and start seeing property emails. Do I buy on-market deals? I've bought an on-market deal once. One time ever. It was last year, heart of the pandemic. Damn it, I said fucking pandemic. Now they're not going to let me promote this video on YouTube because of sensitive subjects. So it'll be on YouTube, but I won't be able to stick advertising dollars on it. Shit, I told myself not to say pandemic or COVID, and I think I probably said it 20 times in the last minute. Do I buy on-market deals? Heart of the pandemic last year, there was a 5-plex on the market for $185, jacked up condition. Went in there, busted the seller down. I went direct to seller too, because we happen to have in our database already from a direct mail lead, but we saw it on the MLS, expired with the agent. We ended up getting it for $85,000. It was on the market for $185. That's an on-market deal I'd do. Very rare that happens. We only pursued it because he was already in our system and his price was already much lower than what it was listed for on the MLS. So we kind of smelled blood in the water, and we got in there and we got the deal. That's the only time ever. I would not ever bother with an MLS deal outside of that. But that's because I have a business that has the resources to work really, really hard to get deals off market. We're already sending out 20,000 mailers a month. We've already got 2 full-time salespeople in here, right? So with those resources, it doesn't make sense for me. That doesn't necessarily mean that it doesn't make sense for you, lacking the resources to go and pursue the off-market deals, especially if you're busy, right? You have a well-paid job, you have a business that you're managing, you don't feel like going in there and learning this whole thing. You'd rather put your learning towards like a craft that you're focusing on that's going to make you more money. Then maybe you buy deals at retail, and you just have to have the right expectations. You have to be cautious and understand that this is a hard market to buy deals the retail way in, all right? High five. Someone wanted to high five me in the question. Do I have a course? I'm working on making it, but guys, I've been really busy, and look, I really do want to make this course, and it's not like it's not financially rewarding for me too, because we would make good money selling a course. A lot of you guys want it, but this is the hard part. And I try to tell you this, and I say that sincerity, right? I want you to understand why I'm here and why the content is as honest and transparent as it is. And it's because social media, although it makes really good money, is making a very small fraction of the total earnings that ACE produces, the ACE family of businesses, right? That's what we call it now. I feel like I'm running a pizza parlor or something like that, the ACE family of businesses. The ACE family of businesses as a collective generates a lot more income and adds to our net worth much more quickly than social media does. This week's profits alone made what social media makes in about 4 months. And if I release that course, sure, fine, that it might double our social media income, but there's so many deals to attend to, so many investors to kind of satisfy here, complicated situations to resolve, tax season, acquisitions, lots of other stuff involved in this business and also continuing to maintain the social media that does make it hard to like shoot video, long video too, because when I make this course, guys, I don't want it to be, and you don't need a course, by the way, right? Someone said you don't need a course, guys. You don't. I'm giving these hour-long videos for free every single week, but people have asked so much. They want something in sequence, handheld, A to Z, more class-like and less stream of consciousness-like, more process-oriented, like a kind of a coherent system. I'll build it for you because the demand is there. But you don't need that if you want to kind of go and just dig around and learn it manually, right? But I must say, if I'm going to make a course, it's not going to be like everyone else out there that gives you 4 hours of video and just bullshit on the surface stuff that you could easily find. It's going to be esoteric. It's going to be basically my business stamped into a format that I'm letting you have, right? Which I'm not afraid of, because this business is all about execution. It's not about intellectual property or anything like that. It's not highly innovative, even though there are some process innovations here. It's going to be really high value, and that means it's going to take a lot of effort from me. So you guys got to be patient with me, because I just can't give you junk, especially with the reputation of influencers out there that just will do anything to make a buck off you. I don't want to do anything to make a buck off you. I want to give you something that you're going to buy and say, oh shit, this was really, really worth it. Why is he selling it for this price? That's kind of how I want to make you feel. So it might take time to get that course because I have that high standard out there. Best source of knowledge for my path in this real estate game. Do it yourself. Go do it. Just go do it. Let's go try it. Put some reps in. Am I going to give us the niche that I target when looking for off-market buyers? I always love this question, the where do you get your buyers question. You're looking at it. Where else would I get my buyers? I got 160,000 people on Instagram. Yeah, we get buyers off Instagram left and right. And I get buyers off Instagram. Well, first of all, buyers with money. That's who I'm targeting, right? I'm not targeting buyers that have a couple bucks to spend. I'm targeting buyers that have a lot of money to spend so we can make it worth building relationships with them. Oh, you meant sellers. Crap. Okay, well, now that we corrected that, where do I target my off-market sellers? I look more at the product than the seller profile themselves. Is this the product that tends to convert at a high rate in markets that are in flux, that meets my investment criteria and my investors' investment criteria? It's all about the product, and then I try to look for product and regions that are highly likely to be less competitive, but for the wrong reasons. Right? I want the properties to perform like the more competitive areas, or comparably so, but be relatively undervalued because the competition's lower, and that increases the chance of mispricing. That's the beautiful thing about real estate. Every asset is a one of one. Therefore, every asset is independently valued. And because it's independently valued, the likelihood of variation in value is higher in both directions, above, right? So there's a lot of people asking too much, a lot of people asking market, and there's some people asking below. It's a science of product. That's all it is. And I wish I can give you a more expanded explanation, but guess what, guys? That would be like a 30-hour live, number one. Number two, you got to figure it out yourself. Just go figure it out. Am I dealing with renters not paying? Very, very infrequently. Very infrequently, which is surprising for like the affordable housing type product that we use. I think it's a function of landlord-tenant law and rental demand and good property management. And we have the issues more when we have subpar property management. We are dealing with one subpar management company. Don't worry, our investors aren't getting this management company from us at all. But we are dealing with one subpar management company, and that's completely affected the asset. The asset with good management in place tends to perform because the market has the fundamentals to support the asset's performance. It's 12:53, so we got a lot of Q&A in today, guys. I'm glad. Find the property, then find the owner, then get in touch. I just buy a bunch of data or scrub the data myself. I get a software engineer and scrub the data myself off the internet. Just tell them exactly how to build the Python script that I want, give them the inputs, give them the process I want, let them give me the outputs, and then I go ahead and manage the data, I interpret it. I'm kind of a junkie when it comes to data. So I get all these seller and property data for a particular county, and then I go through my like unique scrubbing process that I couldn't put into a couple minute description. It's quite an art form. And then we market very heavily to it, and very consistently to it. And that's where everyone loses, right? It's basically public records. That's where everyone loses it starts with the data, then the marketing, right? So people don't know how to like get the right information and then like clean it up and like use it correctly, and filter through it correctly. It's not even about skip tracing. It's just about like who you select, right? Like in your marketing funnel. Number two is like the copy, right? How well you write your message. And the third thing is nobody hits people for that long. Like this industry is very come and go. People show up, they're here for 3 months, they send out 3 months of mail, 6 months of mail, then they disappear. No foresight. They look at, like we talked about with speculative assets, people tend to look at the last like 3 months of production of their mail or their marketing, and then they base all their future production on that. They don't realize that there's a compounding effect of marketing over time. We've been mailing people for 5 years. Some people, the same person for 5 years, every 3 weeks. Every 3 weeks. They know us very well. They may have never spoken to us, but they intimately have a relationship with us through written letter. So that's the key, is not stopping. I don't have a podcast. I got started with a house hack, a house for my parents. That was just a house for my parents. Literally, I didn't make any money on it. And then out-of-state rental that I tried to burn, and I realized the burr strategy is fucking stupid for people that are starting, because you're literally doing a whole flipper's job just to not make the flip profits and keep your cash tied up just to make a few $100s a month, when you could be making 20, 30,000 this quick, put it in the next project and make hundreds of thousands of dollars within a year. But when I realized that, I sold it. Did exactly what I just told you, made hundreds of thousands of dollars in the first year, and rolled it into way more projects, way more, and kind of made this business out of that, the acquisition and disposition of off-market rental properties. Who was I in high school? I was kind of a combination of, I wasn't just a nerdy kid, right? But I wasn't like, like a jock or nothing like that. I always hit the weights, right? So I was in good shape. I wasn't douchey because I was in like all honors classes. I wasn't as outgoing as I am now. I wasn't really shy necessarily. I was shy in like middle school, and then I started to gain confidence. That was it. I mean, I was a pretty smart kid. I grew up in a rough neighborhood, right? And I continue to live in like a not so great neighborhood. So like there were parts of me that like really fit with like kind of like the little nerdy crew, because I was in all honors classes with them. There was parts of me that fit with the scrappy kids, because I was like that. A little bit of everything. Kind of what you see now, to be honest. Not that different. Interesting question. Interesting question. It's very much what you see is what you get. I promise you. I don't think I've really changed that much. What service do you use for mailers? Like it says, oh, this person, I thought that question was genuine. Now I was saying take off the mask. It's so hilarious. Yeah, guys, this is what it is. There's a reason I'm not driving around in a Lambo on this page. What questions we got that are serious here? What service do you use for mailers, or do I do it all in-house? I use a local print company. So you can go to any print company and just kind of see what samples they have. Do something that's appealing, that's different, that says quality, invest in quality, and then just shrink your mail list, right? So you can have like the level of performance you want. Don't compromise on performance. Just do it to the most valuable subsection or cohort of your data, so you can convert. You don't want to compromise on conversion. You want to compromise on the junk leads that aren't going to make you as much money. The leads that make you all the money, if you really hit them hard and hit them right with the right mail piece, and even if it's a small subsection, if you can convert on those, then you'll make substantial profits that'll allow you to afford expanding your list. That's the order you should do it in. What else we got? Flips over burr. Look, if you're new, I've said this a million times the past couple of weeks, and I'll say it one more time really simply. I just get the arguments out of here though, because it's just numbers. If you're new and you need to make money, and you're gonna work as hard as someone would to find an off-market deal at a discount, fix it up, and put a tenant in it, then why keep your cash tied up? If you're good at that and you can generate 30, 40, 50,000 of forced equity in 3 months, why wouldn't you just cash in that equity and put it towards the next deal? All of it, not just 75% that you get back from the refi, but all 100%. Put it towards the next bigger deal where you can add 70, 80, 90,000 of equity in 3 months. It's just math. You'll make more money. The only time I'd recommend burr is when an investor doesn't want to pay taxes because they don't have a next best project. They just cash out and the cash will just sit and they have nothing to do with it that's going to generate a higher return. If the rental property that you've got the cash left in is generating you the highest return and you don't need more income, then leave it in there. That's what I do all the time. I buy properties at a discount for market value that I could sell. I bought a property once 2 years ago. Get this. That story's crazy. It's too crazy for you. I own a threeplex that I got for $25,000 that I could sell for $195 today. Right? Why did I keep it instead of sell it? Because all that income, that big $170,000 profit margin, and it's over 2 years, right? When I first bought it, I could have sold it for like 110, and that was still a big margin. But that like 90 grand I would have made, 85 grand I would have made if I sold it back then instantly, would have been taxed at 50%. I didn't need the income. Why pay that much in taxes? Just keep the property. I could 1031 later and avoid it. That's when you burn. That's when you hold the deal, is when you don't need the cash. But if you've got something you could do with the cash, that's gonna make you a lot more money. And you're gonna do the same amount of work, because all you're doing is just another bird deal, right? You would have done another bird deal regardless of whether you sold the first property or refied. Now you're just gonna do a slightly larger second bird deal that's gonna make you a lot more money. Then yeah, roll it forward, keep growing, get to critical mass. The reason I was able to buy over 60 doors in the past year, over 50 of them cash, or probably near 50 of them, right, like 48 of them cash, was because I sold enough deals in the past and continued to sell enough deals to generate enough income to be able to buy more aggressively. If I had been buying from the very beginning, I never would have had this business. Never would have had this income. And at this point, I probably still wouldn't be at 60 doors. Or if I was, it would be all financed. I would not have the same amount of total equity that I do in my portfolio. My net worth would have been much lower. There's an order of operations to it, guys, and it's all about scaling your net worth as rapidly as possible with respect to your constraints and what your business is capable of producing, right? Can it produce the next deal? Can you execute on the next deal? If the answer is yes and yes, then go for the next deal. Don't keep it all on the first one. Last question, guys. Let's get a good one. Why would I pay a 50% tax rate as an investor? Ordinary income tax, I'll break it down for you. 37% Fed, what is it, 11.8 is what I pay in Cali or something like that. I think it goes up to 13 because I just get my bracket down a little bit with depreciation. Or actually, depreciation doesn't apply to California, fuck. 37, 13, and then state of Indiana. Corporate tax rate's like 5% there. So I'm paying over 50%. It sucks. Fed, state, corporate. Ordinary income means rent, it means flip money, it means short-term capital gains, means everything that's not long-term capital gains is ordinary income. So yeah, I pay too much money in taxes. Okay, fine. One last question. How do I feel about wholesaling real estate to get started? It's a sales business. If you can execute on that, get after it. And that's gonna be my ending line for you guys. If you can execute, get after it. Don't do stupid, risky shit. Have a great weekend, y'all. This is gonna go on YouTube too. And hey, giveaway is gonna be in a few minutes. Watch for that announcement. See you later.